Hi, everyone. I wanted to take a few minutes, as I said, to go over problem 12.3b. So hopefully you completed the statement of cash flow and are ready to review it. Excuse me, I'm going to speak. Excuse me. Sorry about that. That was very rude. Gazelle Corporation's current year income statement, comparative balance sheet, and additional information follow for the year. All sales are credit sales. Excuse me, I'm just sorry, goodness. I'm in my office. I must have something in my office. Okay. All credits to accounts receivable reflect cash receipts from customers, and all purchases of inventory are on credit, and debits to accounts payable reflect cash payments for inventory. So as we know, we get 2 years worth of information on comparative, maybe more, financial statements. That doesn't mean it's a 2-year accounting cycle. It's just instead of just showing 1 year accounting cycle, they show individual accounting cycle years and the end of year information for each. So here we have 2 years, the current year and the prior year, current liabilities, or I'm sorry, current assets, property assets, liabilities, and equity. Then we have the income statement, which we know is important to have for our statement of cash flow. And then they give us some additional information that we have to keep in mind as we're going through our answer. So I'm going to stop sharing this and go ahead over. And I do apologize. So you have your book in front of you, but I'm going to go over to the answer key so you can see this. Okay. So remember, let's just start here because that looks like a lot of stuff there, right? We have Gazelle Corporation. This is a formal financial statement, so statement of cash flows for the current year ended December 31st. We start with our label, cash flows from operating activities. Now, remember, we're doing the indirect method, and the indirect method, we are actually converting net income that's an accrual basis number to profit as if we used cash basis accounting. So what would have been our profit if we only recorded operating activities when cash was involved? So in order to convert that, we need to add and subtract certain items. Remember, our first major item, we deal with adjustments to reconcile net income to net cash provided by operating activities. Income statement items not affecting cash. Remember, we always add back depreciation expense. We would never debit or credit cash in that. So it should have never been subtracted to get to net income if we were using cash basis. So we add it back to the net income that we did subtract it from originally. Remember also, any gains or losses on the disposal of equipment or any plant asset doesn't mean it's not accounted for, but it's not an operating activity. So if we're converting our net income to a cash from operations, add it back. We shouldn't have subtracted it. So those are the major items on the income statement. Now, if this was a gain, we would subtract it because it should have never been added to our net income. We're just washing out the effect of those items that were either added or subtracted to get to net income. Now, the next major items that are looked at are current assets and current liability changes. Remember, current assets and current liabilities are those assets and liabilities created by our normal operations: accounts receivable, inventory, prepaid expenses, accounts payable. Okay, so any change in those affects our cash flow from operations. Now, what we need to be careful of is the wording. And you'll see here, there's a decrease in accounts receivables from last year to the end of the current year. So we always have to compare the end of the prior year to the end of the current year. And accounts receivable actually decreased in amount. So why is it positive? Well, in the statement of cash flow, we're not asking or showing here how accounts receivable change. We're showing how the effect or what the effect on cash is from the accounts receivable change. So if accounts receivable decreases, that means we collected more cash from the end of last year through the end of this year, $36.50 more, so added to cash. Inventory, that also decreased. So that means we're not spending as much from the beginning of or the end of last year to the end of this year. So that's an increase in cash because of that. So when a current asset decreases, the effect on cash is an increase, and vice versa. If it increases, the effect is a decrease on cash. And think about it. If an asset increases anywhere, you're spending more cash, so the effect is decrease. But in our situation, the last current asset decreased also, prepaid expenses. So they went from a balance of $17,000 down to $15,100, increasing cash $1,900. Now, when a current liability changes, it's the same impact on cash. So if in this case, accounts payable decreased and went from $102,000 decreased dramatically down to $17,750. Well, why? Because we paid them off. Well, then if your liability decreases, the same impact occurs to cash because that's what you use to pay them off. So we decrease cash, or decrease, show this as $84,250 decrease. Vice versa, if accounts payable increases, that means you paid less cash for something. So that means there's an increase in cash. Okay, so current assets have an opposite impact on cash. Current liabilities, same impact. So when we add and subtract these adjustments, remember, all we're doing is adjusting net income as it currently stands as an accrual basis number to net income as a cash basis number. So if we used cash basis for our operating activities, our cash from operating activities is $130,200. Now remember, our statement of cash flow has two other sections: cash flows from investing activities. So this is where we show how cash is impacted from the purchase and sales of long-term assets. So I'm just going to, and I don't think you're going to be able to see me do this because I have to go back to the book online, but right in part B and C, they tell us the company sold equipment costing $51,000 with an accumulated depreciation of $22,850, and they sold it for $26,050. So what's the impact on cash? A positive cash from the sale of equipment. So that's what we're reporting here. How much cash did we get on a sale? How much cash should we pay on a purchase? The other part, in part C, says they purchased equipment. It cost $113,250. They paid in cash $43,250. So that's the only impact on cash. The rest they borrowed. So when you see this $43,250, remember, we're not putting how much did the equipment cost, but how much cash was paid for the equipment that was purchased. So those are the only two items that affected our investing activities. So we take the net. Overall, there's a negative cash. So it's net cash used in investing activity. So when it's a positive cash overall, it's provided. The final area of our statement of cash flow is where we show cash inflows and outflows from financing activities. So we're generally looking at long-term liability transactions and stockholder equity transactions that affected cash. Okay, so if I'm just going to go back over to my book, and it says in part D, paid $42,500 cash to reduce the long-term notes payable. Well, when we look at our answer key, it tells us cash paid on long-term notes, $42,500. It further goes on to say that they issued 3,000 shares of common stock for $15 cash. Okay, then the impact on cash is a positive cash from selling stock. And in the final F, declared and paid cash dividends of $53,600. So if they paid those, the impact on cash is a decrease. So those are your normal types of items that would affect financing activities. So we take the net of those three items and determine that overall there was a negative cash from financing activities. Yeah, we paid out dividends and paid off long-term debts greater than what we sold stock from. So the net cash used in financing activities, $51,100. Now, I don't want you to think that's a bad thing. No, the company had $130,200 of operating cash. That's awesome. So they used some of it. Overall, they paid and invested $17,200. So we'll subtract that. And they paid off some debt, paid some dividends. Awesome. So the net cash used in their financing activities is also subtracted. So we net these three. And when we net these three, that will give us how much cash changed overall from the beginning of the year to the end of this year. So our overall change is a positive amount, a net increase in cash. How do we know if it's okay? Well, what was cash at the end of last year, beginning of this year? You get that from your balance sheet, $61,550. Add the change, and that should be the balance that is in your cash account at the end of this year. And it is $123,450. So that is how we complete the statement of cash flow. One final note. Remember when we bought that equipment and we only paid $43,250 in cash? Well, don't forget, we want to note it right after on the statement, but it's right at the bottom of the page. We did have a non-cash investing and financing activity. So that's when we might buy something like a piece of equipment, but we don't use all cash, we use some financing. So that transaction is nowhere up in the top except for the $43,250. So we let people know, hey, we did have a non-cash activity with regards to investing and financing. We signed a $70,000 long-term note. So part of that equipment was paid in cash and part is through a loan. And it's not accounted for up in the top of that statement of cash flow. Okay, so that is our statement of cash flow. As I told you in the beginning of the semester, we get to it at the end. So please review this really well. And if you have any questions, send me an email.